All right, if you are thinking about joining us in the Crypto Investors Mastermind, you probably have a few questions, as well you should. And so in this series, I'm just doing a few of the frequently asked questions and breaking down some of those that I get the most often so that you have all the information that you need to make an informed decision. Today, we're going to be talking about everybody's favorite topic, which is risk, because everybody who comes through the door at some point or another is going to ask, hey, what are the risks involved? After all, this is an investor strategy, meaning that in all things investment, there will always be some level of inherent risk. So let me share my screen and we can dig right in. And risk is kind of tricky to quantify and to pinpoint. It's like, how do you measure it exactly? So what I want to do is outline what I believe are 5 primary considerations as you evaluate risk factors, whether you are investing in a crypto market or whether you are investing in any other type of market. Okay, so the risk outline profile here will apply to you regardless of what category of investment that we're talking about. Okay, number one consideration, in my opinion, is taking into factor time and optionality. What does that mean? Well, when we talk about risk, we're in the context of investment, we're saying, hey, I've got this capital, let's say it's $50,000, okay? What do I do with it? And how do I put it in a safe or lower risk environment, right? Well, you have to take into account a couple of things. Number one, as time marches forward, I guess you can call it riskiest, or rather the most predictable thing that we know is if you just hold cash, throw it in a bank account, it will gradually lose value or purchasing power over time. In fact, they say that over the course of 100 years, your dollars lose approximately 90% or more of their value. And when you think about that, that's kind of insane. Meaning, if all you did was shove your money in a bank account or a mattress, that's putting yourself at risk. It's a predictable risk, but it's the risk of, hey, if my money doesn't do anything, it just sits there, it gradually loses its power, which is to purchase things for me. Now, when I say things, I don't necessarily just mean physical objects. I mean, ultimately, optionality. Because what is money? I mean, money is the opportunity to give ourselves new options in life, right? So when you keep cash, yeah, you don't necessarily want to keep it just long-term stuffed away, but you give yourself optionality. You give yourself different opportunities to invest in assets, buy a thing that you like, give to charitable causes, whatever the case may be. So as we evaluate risk, you have to take in consideration it can also be a type of risk. It's predictable, a type of risk to do nothing. But by holding cash, now we've given ourselves some options. Okay, so that's the first thing. Number two is early adoption. Now, what I mean by this is we've all seen the stories of people that, for example, let's go traditional finance, right? They invested in Tesla, like in the early days of Tesla. And now in retrospect, we go, wow, they were so smart. That was so obvious. But in the early days of Tesla, that probably felt like an insane risk, right? But on some level, if you are thinking about investing in a new innovation or technology, which is what DeFi is, you have to assume it, like psychologically, the profile of an early adopter, meaning you're willing to assume that upfront risk in order for the potential of a far greater return versus the late adopters and laggards who jump on the train way after the fact. Sure, they assumed less risk, but they missed out on the opportunity. They didn't give themselves enough optionality, so they couldn't jump on a new opportunity when it arose, and they didn't position themselves to make those kinds of moves. Okay, so that's number two. Most people that I talk to that are thinking about getting into crypto or already in crypto have at least some elements of the psychological profile of an early adopter, meaning I can see what's coming. I don't want to get left behind. Therefore, I'm willing to take more risk, right? I put it in quotes because it's a form of risk, but you're basically just trading one risk for the other. You're trading the risk of, let me just sit on my cash and do nothing, or let me invest in the stock market. And you're saying, okay, those are risky too. Let me rather assume a different type of risk because that one has an asymmetric risk reward profile. Number 3 consideration, traditional finance versus decentralized finance, okay? TradFi versus DeFi, you maybe see these phrases thrown out there here and there. Basically, this is just acknowledging, excuse me, this bad cough this week. This is just acknowledging that the world is shifting. How humans transact and how humans exchange value, right? That's the world of finance. That is shifting. And we're at the very, very beginning of it. So if you think you're late to crypto, you're not. You're at the very, very early stages of the development of the infrastructure of decentralized finance. And you could stay in traditional finance if you want to. You can invest in the stock market and other things of this nature. It's not bad, okay? I have a whole life policy. Like, that's not a bad investment. It's just that if I want to move forward into decentralized finance and not get left behind, I have to say, hey, you know what? There will be some inherent risks with this. Part of the market is super speculative. A vast majority of the market is absolute trash, which is why you have to learn how to identify, hey, what's the small pocket, the 4 or 5% of decentralized finance that are actually legitimate projects that are contributing to the development of the infrastructure of what is becoming the future of this new worldwide financial ecosystem, okay? So again, is that risky? Well, yeah, but you're basically just trading one risk for the other. And again, it's hard to quantify this, is this one a 7 out of 10 and this one's an 8 out of 10? I don't know how you'd really put a number to it. I can tell you that in my opinion, it's less risky to invest in what you see as innovation in the future rather than what you see as what's already been established in traditional or legacy financial institutions. Okay, number 4 consideration, volatility and hedging. And the reason I put this one in there, because if you've watched some of my other videos, we're talking about a specific mechanism. Some people call it yield farming, where we're pairing assets together. And by becoming a liquidity provider, we're creating an opportunity where we can generate trading fee income, meaning millions, if not billions, of swaps happening in the world of decentralized finance. Each one of those incurs a small transaction fee. When you're a liquidity provider, you take a cut of those transaction fees. Now, what I mean by volatility and hedging in that context is some people will tell you, oh no, being a liquidity provider has way more risk because of potential for impermanent loss, and they'll throw out all these words that they don't necessarily understand what they're really talking about. Well, in light of the big picture, being a liquidity provider is actually a form of hedging, meaning that I can pair 2 assets together, and yes, I still am exposed to both the market upside and downside of those 2 assets, meaning the risk there is the equivalent if I just held unpaired assets, meaning the market could go up and down. We'll talk about that at number 5, fluctuations versus actual losses. But in many cases, by pairing, for example, blue chip assets with stablecoins, I'm able to hedge in the sense that regardless of the short-term volatility and fluctuations of the market, I'm still generating trading fee income, which is a way to offset any potential impermanent loss, right? Not locked in impermanent loss. And then as the market fluctuates, I use those positions to hedge a little bit, meaning in this method, you're not chasing the most absolute possible maximum returns. We're talking about reasonable returns over time. There's another video about what is the ROI, but in a nutshell, 50 to 100% per year on average, just in trading fee income. And that doesn't even include any appreciation of your base assets that will also naturally occur long-term in the world of decentralized finance. Okay, and then number 5, finally, is fluctuation versus realized loss, okay? When we talk about risk, some people go, oh, but if you buy it and then it goes down, then you lost money. No, if you buy it and it goes down and then you sell it when it's lower than when you bought it, you realize a loss, okay? In the short term, market fluctuations in our strategy, that's what we want. So we want Bitcoin to go up and then retrace 40% and then go up a little bit more and then retrace and then go up a little bit more and retrace 40, 50% and then go up. We want that up and down action. We even like sideways action, even though most traders don't, because we're counting on trading volume, which generates trading fees, which allows us as liquidity providers to collect more trading fee income. So we like fluctuation. Fluctuation is our friend if you have the right outlook on it, right? So market goes up, market goes down, market goes up, market goes down. Meanwhile, I'm sitting here going, cool. I like that because I've hedged by becoming a liquidity provider. And now I get to enjoy additional returns that result from those fluctuations. And I don't have to realize those losses, especially impermanent losses, unless I make an incorrect move, in which case, yes, you could incur some impermanent loss, but only if you don't understand how to navigate the process of being a concentrated liquidity provider and rebalancing and some of these other factors and considerations, okay? That's outside the scope of this video. I just want to acknowledge that unrealized losses aren't losses until you actually make a move that locks them in, okay? So when you know what you're doing, you don't have to do that, which means your risk profile actually goes down rather than increases, okay? So ultimately, I would tell you that what's the risk factor? Well, if you try this method and you don't have guidance and you don't have mentorship or support, yeah, you're really high at risk. But if you don't know what you're doing in the regular stock market and you start day trading or Forex or whatever, you're also incurring an insane amount of risk, not because of the market that plays a factor, but you're assuming an insane amount of risk because you don't know how to navigate the climate and the context that you're operating in, okay? So fluctuation, we like. It's not a realized loss until you actually sell off or make a move at the wrong time, okay? Now, to summarize this, what is the riskiest path? This is just my opinion, okay? So someone else might give you a completely different perspective. That's fine. Everyone's entitled to their own perspective on how this whole process works. To me, and to be clear, like I'm biased because I'm heavily invested into the crypto market. But to me, the riskiest path is number one, doing nothing, like we talked about with cash and time and optionality. Like if you do nothing, your cash sits there, it's just losing value, okay? So doing nothing to me is the riskiest path. Number two, staying locked in the past. And I would add to this education, meaning not educating yourself, not participating in communities that can actually like guide you down a path so you can make more progress in 3 months than most people make in 6 or 7 years. Staying locked in the past means you go, you know what? I already know everything that I need to know. I'm fine the way it is. I'm just going to kind of carry on. Well, if you keep doing what you've been doing, you're going to keep getting the same results that you've been getting, right? If you want a new result, you have to either take a new action or learn a new path or both. Obviously, I'm advocating for learn the new path and take a new action. But when you're locked in the past, you're not able to look forward to see what is happening, which is related to number three, not betting on innovation. Okay, again, just my opinion. I think it's higher risk to not bet on new innovations because yeah, some of them might tank, some of them might go to zero. But if I have a portfolio of, let's just say 20 crypto assets and, in various categories, different project types and whatnot, and let's say even 5 of them tank and go to zero, I don't think that's going to happen. But even if that happened, well, the potential upside, again, asymmetric risk reward, the potential upside of the ones that did make it is so much higher that it outweighs any losses that I might have incurred from a few bad calls along the way. So what's the riskiest path? Doing nothing, locked in the past, not betting on innovation. And to kind of wrap this one all up, I don't want to make these videos too long, just want to keep it short and to the point. I want to share a quote. You may have heard this one before, and this is not a specifically crypto quote. It's just more like a mindset shift, okay? This is from Steve Ballmer, who used to be, at the time, he was the CEO of Microsoft, okay? And this was during the era of like the iPhone was just coming out, and it was like, oh, there's Blackberries, but what about iPhones? And we're working on this other thing. And, nobody really knew what direction the market was going to take for sure. But here's a guy who's supposed to be the leader of one of the biggest tech companies around. And he said, there's no chance that there's no chance that the iPhone is going to get any significant market share. So if you believed him, and you took that path, you actually were incurring the most risk. But we only know that in retrospect. At the time, I'm sure there were people who looked at the iPhone and went, whoa, this is brand new. No one's ever seen anything like this before. We don't know if it will get adopted by the masses, but I'm looking at it as a new development in communications technology that blends things that we already have, but just puts them all together and makes them better. That makes sense to me. It's innovation. It's pushing things forward into the future. And so if you took the big risk of betting on Apple and the iPhone early on, you got rewarded like crazy good. Okay. So I share that quote only to solidify and reiterate that the risk here, yes, there is risk involved in investing in crypto. In any type of market, there will be inherent risk involved. But again, in my opinion, to sit back, do nothing, and think that you're going to be okay, to me, that's the riskiest path. Okay. So that was part of the motivation behind even opening up the mastermind community in the first place, was acknowledging that, hey, there's a lot of people out there. They might already be savvy investors. You might already be invested in various markets. That's good. And all I'm suggesting is, hey, there's an opportunity here to get involved in new innovations that are pushing the landscape forward. Again, the innovation of how humans transact and how humans exchange value. Think about that. How we transact, how we communicate, how we exchange value. Like that's like what it is to be a person, right? And that's what drives any financial market in any culture across any time frame. So we're not talking about some fly by night, here today, gone tomorrow kind of approach. We're talking about an innovation in something that will forever be a part of the global human civilization. Okay. All right, that's all for this one. I'm going to leave it. I'll make some other videos down the road as more and more questions come in. Just know that yes, risk, but you have to weigh it in your own mind and go like, okay, but is that risk greater than the risks that I'm already taking that are either doing nothing or investing in other categories of things or staying put in traditional finance? You have to evaluate what you think is riskier. Because again, how do you quantify risk? I'm sure there's some brilliant mathematician somewhere that can do that. I'm just acknowledging that we don't always know exactly what the quantified value of risk is until we look back and go, shoot, it actually wasn't that risky to invest in innovation because that ended up being the least risky path long term. All right, that's it for now. I'll see you guys on the next video.